Welcome back to the program, ladies and gentlemen. On this segment, we're going to tackle a couple of those hard questions. We talked a little bit in the first segment about some things that we are doing differently at the office. And then, of course, the question of why don't they just close the markets? This segment, we're going to talk about some of the harder questions that are getting asked out there, like why should I stay invested through all of this? And ultimately, what's going to be the economic impact? Welcome to the program, of course. This is Dollars and Cents. A little different format in today's world. I'm still Joel Garris of Nelson Financial Planning, but I'm not sitting in the studio. We are doing this show live on Sunday morning. I am at my home and the producer is at the radio station. So got the call late Friday about the change of format and doing it remotely. And so here we go. A little bit of a different approach and certainly one though that we're, I guess, able to work through with technology the way that it is. So what's the economic impact? I mean, I think that's the big question out there. And obviously this virus and the reaction to it and the attempts to slow the spread of it will certainly have a significant economic impact. We continue to see this certainly as a headline-driven event rather than some kind of a systemic economic problem, much like, say, for example, 2008, right? A lot of the issues there had to do with some underlying issues with the structure of the economy. This is certainly a little bit different than that in that it's much more of a headline event. So our viewpoint remains that once this headline event passes, things will recover. It will certainly take some time to do that, but things will certainly recover. So that's the important thing to remember, is that markets move faster than data. Oftentimes right now, for example, markets don't really know kind of what the numbers are, what the data is on this, and so they're just kind of jumping to their own conclusions and swinging wildly from one day to the next. And as that pricing, as that uncertainty continues, then you see the markets trying to figure out how to price it. As the data emerges, here's the reality: the markets will have that new information, that sort of real information, and then adjust accordingly and ultimately reduce volatility. Here's the key concept: by the time you feel better, the markets will have already priced that in. So this notion of I'm going to be able to use my gut or my feelings to somehow navigate through all of this, that is going to be a very difficult situation. I think it's important to look at your portfolio right now. I think it's important to look at your mix. Make sure that you have predominantly large companies in it. That's a concept that we've been talking about on this program for years and years and years now, probably going all the way back to when my father-in-law, Jack Nelson, did this program 30 odd years ago. So large companies, I think, certainly have an economic impact. We're seeing that across the board. But at the end of the day, folks like Disney, Amazon, they're going to be okay. They're going to get through this. The reality is, and where my concern is on those smaller companies that are not as capitalized as some of the larger companies. And certainly the market is sort of taking that approach. If you look at large companies, they're certainly down close to 30% since the beginning of the year, but a lot of smaller companies and a lot of small company indexes are down closer to 45%. So there's definitely a gap between how the market is sort of trying to price this big uncertainty, in that when you look at the performance of larger companies over smaller companies, clearly the larger companies, and the expectation would be that they'll be able to weather this much better than a smaller company. And that's where the real concern, of course, comes in, is that you've got a lot of impact on small businesses and small companies that ultimately will be a significant impact on those. And so that's really where our concern is for those smaller companies, and how do they make it through this significant economic impact. Remember, the market prices the uncertainty, and it's going to always err on the side of negative. And ultimately, as you start to get more data on this, and ultimately the markets will adjust accordingly quite rapidly, which of course leads us to our next question, which many investors are asking us, and that is, why on earth would I stay invested through this? This is just gut-wrenching. This is like a kick in the gut. And why on earth would I stay invested through all of this? And certainly that's a fair question to ask. It's certainly very frustrating out there. And as we reminded our clients this past week, this is where investing is hard. It's very simple to be an investor. It's very simple to have that perspective of, oh, all I have to do is be invested and stay consistent, and it sounds so simple. And the reality is, right now is certainly where it gets hard, and that's why many folks don't succeed at it, because what people forget is that money is a highly emotional tool, and because of that high emotion level, we often get so fixated and ultimately make some mistakes, because the speed of the market is such that it can react much faster, and consequently those are the kinds of things that we need to keep in mind. Here's some data to sort of back up why it's so important to be consistent. Number one, we often forget that the best days are clustered around the worst days. If you look at 2008, what many people don't realize is that even though that was a terrible year for the markets, 7 of the best performing days out of the top 20. So if you look at the top 20 best performing days since 1945, that's over the course of the past 75 years, 7 of those top 20 best performing days in the market actually occurred during the course of 2008. That probably surprises you. It surprised me when I heard that statistic, but it certainly backs up this notion that volatility has two sides, both negative and positive. When you look at that statistic of just for 2008, where you had 7 of the 20 best performing days in the market over the past 75 years, that's a big underlying reason why you want to remain consistent in your investments. Here's the other impact that has. So if you look at the returns in the market over the course of the past 20 years, annualized return is right at about 7.2% as measured by the S&P 500. So you've got 20 years. 20 years, that's 250 trading days a year times 20, so you got 5,000 trading days. All you have to do is miss the best 10 trading days. And we're not talking about 10 trading days per year. We're talking about 10 trading days out of the entire 5,000. And your annualized return, instead of that 7.2%, drops all the way down to 3.8%. That's a pretty significant difference. And if you think you're going to be able to zig and zag around this, you're just not going to. And all it takes is to miss one or two of these recovery days, and that ultimately winds up really undermining your long-term performance. Just remember that statistic, 7.2 down to 3.8, just missing 10 days out of 5,000. That's pretty dramatic. I don't know how you're going to manage to get around that. And certainly history says good days are clustered around bad days, particularly when you got 7 of the best trading days, or the top 20 trading days, occurred during the course of 2008. The reality is, by the time you feel better, you're going to the markets will ultimately be ahead of you on that, because they move that much quicker. People emotionally don't recover or feel better until they actually see it. Well, how are you actually going to see it? You're going to see it when the market's higher, and then by then it will be too late. You get the psychology of how you can, get trapped into that cycle of expectations versus reality, and before you realize or come to the conclusion that, hey, everything's better, the market will certainly be very much in front of you. So we encourage you to look at your portfolio. Certainly now, the reality is that be careful about making a rash decision on it. Certainly call your advisor, have a conversation with them. You should certainly have been hearing from them all along the way during the course of this crisis. And so consequently, those are the things that you can be doing now. I do have sympathy for the folks that are having to call into call centers right now. Those are obviously overwhelmed. There's long hold times, there's long wait times. So my sympathy is with them. And often the advice that you get on call centers is intended to move the call along. And the reality is that it's a much shorter call to say to somebody, hey, you don't want to run the risk of losing any more. Great, let's put you to cash. That's a much shorter conversation than trying to encourage people to stay invested, to give them these types of statistics that we're giving you on the program this morning as a way to encourage you, hey, you're not going to be able to time this thing. You're not going to be able to get in, get out. The reality is this thing is moving way too quickly to come to any conclusion one way or the other. But certainly if you're calling into a call center, it's easy to move you along by just simply moving you over to cash. So be careful of that. If you use a call center, that's fine, but just understand that the motivation there is to move you along as quickly as possible. The reality is going to cash is a much, much shorter and easier conversation for the individual to have than walking you through, hey, here's what's happened in history, here's the things that we've seen before, and at the end of the day, this too shall pass. So some important distinctions there in terms of sort of what's the economic impact and why you should continue to stay invested even during this tough period of time. So we're going to slide to the break. We come back from the break, we're going to start talking about some of the nuts and bolts about taxes, about finances, about potential government stimulus, all of that on the program. So stay tuned. We'll slide to a break. You're listening to Dollars and Cents with your host Joel Garris of Nelson Financial Planning on News Radio, WFLA Orlando.